The silver market looks calm on screens, but calm is often a disguise because the most fragile systems appear stable right before trust begins to thin. Most people think silver trades like stocks, numbers moving smoothly as buyers and sellers meet, yet silver is not an idea, it is metal that must exist somewhere. This gap between what is shown and what must exist is where the story begins, because markets depend less on metal than belief. For decades, trading promised silver without showing it, creating a system where ownership became paperwork instead of weight, and few noticed the difference. The paper market grew faster than the metal beneath it, not because of conspiracy, but because it was efficient, profitable, and rarely questioned. Exchanges like COMEX were built to manage risk, not deliver truckloads of bars, yet delivery remained the promise that anchored belief. Most contracts were never meant to end with metal changing hands, because closing positions early kept the system liquid and predictable. That assumption worked as long as most players wanted price exposure, not silver itself, and the system rewarded everyone who stayed abstract. But abstraction creates distance, and distance hides strain, especially when real-world demand begins to care less about screens. Industrial users quietly depend on silver in ways investors rarely see, embedding it into electronics, energy systems, and medical tools. Unlike gold, silver is consumed, scattered, and rarely recycled efficiently, which means supply pressure builds invisibly over time. Meanwhile, vault reports from institutions like the London Bullion Market Association became symbols of confidence few people actually read. Those reports describe categories, not certainty, and the difference between allocated and unallocated silver is rarely explained to the public. Unallocated silver is a promise shared by many, backed by accounting rather than bars, and it works until too many ask the same question. History shows this pattern repeating, where systems designed for speed struggle when participants suddenly care about substance. In the late 1970s, the Hunt brothers did not break silver by buying metal, but by forcing delivery expectations into view. Rules changed, not to punish speculation, but to protect the system from a test it was never designed to pass. That lesson lingered quietly, teaching institutions that confidence matters more than clarity, and that stress must be managed early. Modern markets learn to smooth signals, releasing reassurance before concern could concentrate, turning volatility into a controllable event. Yet reassurance depends on trust, and trust depends on consistency between promises and reality. When inventories shift, delays appear, or language changes subtly, attentive observers notice patterns others dismiss as noise. Silver's breakpoint is not a number or a date, but a moment when too many participants want the same thing at once. That moment does not announce itself loudly because systems fail gradually, teaching patience before demanding attention. This story is not about silver rising or falling, but about how markets reveal their limits through behavior, not headlines. What looks stable today often reflects yesterday's assumptions, and silver quietly asks whether those assumptions still hold. The real tension in silver appears the moment someone stops wanting exposure and starts wanting metal, because that single choice quietly challenges how the entire market operates. Futures markets function smoothly because most participants never intend to touch silver. They trade expectations, timing, and confidence rather than weight and logistics. Delivery clauses sit unnoticed in contracts, rarely used, quietly assuming that interest will fade before metal must actually move. This assumption holds until behavior changes not suddenly, but persistently, as more participants choose certainty over convenience. When buyers hold contracts to expiry, the system does not break, but it slows, revealing how many steps sit between promise and fulfillment. Each delivery request is manageable alone, yet when timing aligns, even a well-run system feels friction it was not built to advertise. Inventory reports appear precise, but precision is not the same as availability, especially when categories hide ownership and obligations. Eligible silver exists in vaults, but it may already belong to someone else, pledged or leased, present, but unreachable at that moment. Registered silver is smaller, more sensitive, and carries the burden of expectation when delivery suddenly matters. As registered stocks fluctuate, explanations follow, technical and calm, designed to maintain confidence rather than invite scrutiny. Exchanges like COMEX were designed to manage risk efficiently, not to operate as retail metal distributors. That design choice is rational, yet it creates tension when participants test the edge of what was assumed, not guaranteed. Institutions operate across roles, acting as traders, custodians, and intermediaries, creating efficiencies that blur simple narratives. This complexity is not hidden, but it is rarely understood because understanding only becomes urgent under stress. Industrial users approach silver differently, caring less about price discovery and more about continuity of supply. When production depends on silver, delays translate into real costs, missed deadlines, and operational risk far beyond market charts. Unlike investors, factories cannot substitute patience for material, forcing them to act when availability feels uncertain. During strain, markets rely on cash settlement, incentives, and negotiation to prevent visible disruption. These tools work, but repeated reliance changes expectations, teaching participants that fulfillment is flexible, not absolute. Over time, flexibility becomes normalized, while certainty quietly erodes beneath polite adjustments. Commodity history shows this pattern repeatedly, where systems stretch behavior before they change structure. The stress does not announce itself through prices first, but through process, timing, and language. Silver's breakpoint forms where logistics intersect belief, not where volatility spikes. Markets rarely fail loudly at first. They negotiate, adapt, and reassure until attention is unavoidable. What matters is not whether delivery fails, but how often the system must work to avoid testing itself. Silver today offers a lesson in how modern markets reveal strain slowly, rewarding those who watch behavior instead of numbers. Silver markets do not rely on metal alone, they rely on trust, because trust allows distance between ownership claims and physical reality to exist. Over time, that distance became normal, even efficient, as fewer participants felt the need to verify what sat behind their contracts. Most market users never ask where silver is stored, who controls it, or how many claims exist against the same bars. This works because modern finance is built on delegation, where responsibility is passed upward to institutions assumed to be competent. Reports, audits, and assurances replace visibility, creating confidence without requiring understanding from participants. Vault statistics appear authoritative, yet they are summaries, not guarantees, designed to inform without provoking deeper questions. Terms like allocated and unallocated sound technical, but they define whether silver belongs to someone or is shared as a promise. Unallocated silver expands flexibility for banks and liquidity for markets, while concentrating trust into a narrow set of custodians. As long as trust remains intact, efficiency improves, costs fall, and the system feels resilient. But trust behaves differently than supply. Because it does not deplete gradually, it weakens quietly, then shifts suddenly. Small inconsistencies rarely cause alarm, but patterns do, especially when explanations change tone or frequency. Language becomes softer during stress, emphasizing routine operations, temporary adjustments, and market stability. These phrases are not lies, they are tools, designed to keep behavior orderly during moments of strain. Institutions like the London Bullion Market Association exist to coordinate trust across participants who never meet. Their role is not to alarm markets, but to standardize confidence so transactions can continue uninterrupted. This responsibility creates a bias toward reassurance, because uncertainty itself can become the problem. History shows that systems often prioritize continuity over clarity, especially when clarity might provoke coordination. When too many actors react at once, even healthy systems struggle to absorb the shock. Silver's market structure quietly evolved to prevent that synchronization, spreading demand across time and instruments. Paper claims allow pressure to disperse, delaying the moment when physical limits must be confronted. Yet dispersion does not remove limits, it only postpones their relevance. When delays accumulate, participants begin noticing timing mismatches, substitutions, and procedural friction. None of these alone prove failure, but together they signal that trust is doing more work than metal. This is the hidden cost of abstraction, where confidence substitutes for verification. Markets built on trust are stable until trust itself becomes the variable. Silver's story here is not unique, but it is unusually clear because metal cannot be printed or redefined. When transparency fades, systems depend on behavior, not structure, to remain stable. And behavior changes first among those closest to supply, not those watching prices. Understanding this shift explains why breakdowns surprise observers who only track numbers. Silver teaches that trust is strongest when invisible and weakest when finally examined. The most misunderstood feature of the silver market is not leverage or pricing, but how carefully the system has learned to delay moments of confrontation. Modern markets are not designed to fail suddenly. They are designed to bend, absorb pressure, and redistribute stress before it becomes visible. When demand tightens or supply feels uncertain, the first response is rarely disruption, but adjustment, quietly changing how obligations are met. Deadlines become flexible, settlement options expand, and incentives appear, all framed as normal tools of efficient markets. These mechanisms are not emergency measures, they are embedded features built from decades of learning how crises begin. Each adjustment buys time, allowing participants to step back rather than rush toward the same exit at once. Time is the most valuable asset in financial systems because time prevents coordination, and coordination is what turns stress into events. Silver markets use time creatively, stretching delivery windows, encouraging rollover, or offering alternatives that reduce immediate pressure. None of this violates rules because the rules were written with flexibility precisely to avoid rigid failure points. This is why breakdowns in commodities rarely look like breakdowns at first, they look like administration. Historical accounts show that exchanges survived not by being rigid, but by redefining what fulfillment means under pressure. In past commodity squeezes, settlement shifted from substance to equivalence, preserving order while quietly changing expectations. These moments are later described as orderly, even responsible, because visible panic was avoided. But avoiding panic often requires postponing clarity, and postponement accumulates unresolved questions. Participants closest to physical supply notice these shifts first because logistics respond faster than narratives. Delivery timelines lengthen slightly, sourcing becomes more complex, and substitutions are discussed more openly. Each change is explainable, yet together they alter how confidence is maintained. Institutions managing these processes prioritize stability because instability threatens the entire system, not just one market. That priority shapes communication, emphasizing continuity and resilience even when processes become more complicated. Complexity itself becomes a buffer, making it harder for outsiders to identify where strain concentrates. For most observers, nothing appears wrong because prices remain orderly and contracts continue to trade. But markets do not break when trading stops. They break when meaning changes. Silver's hidden breakpoint is not a dramatic failure, but a gradual shift in what ownership, delivery, and certainty represent. As stress is delayed, responsibility moves away from structure and toward discretion. Discretion relies on judgment, relationships, and confidence that cooperation will continue. This works until participants question whether discretion still aligns with their interests. When that happens, behavior changes quietly, long before headlines catch up. Systems that depend on delay teach an important lesson about fragility. They reveal that stability is often the result of constant intervention, not natural balance. Silver shows how markets can function smoothly while slowly consuming the assumptions that made them trustworthy. By the time those assumptions are questioned openly, the system has already been teaching the answer for years. What finally breaks in the silver market is not price, volume, or headlines, but a shared assumption that the system will always work the way it has before. Markets survive on routine because routine removes the need for constant decision-making, letting participants act without questioning structure. For years, silver rewarded those who treated it as exposure rather than substance, reinforcing habits that felt rational and efficient. Over time, those habits became invisible rules, shaping behavior without ever being formally stated or challenged. The system depends on most people believing that delivery is optional, abstract, or someone else's concern. When that belief holds, everything feels liquid, flexible, and orderly, even if physical limits quietly tighten underneath. The breakpoint appears when that belief weakens, not all at once, but unevenly, across different parts of the market. Some participants begin caring more about certainty than convenience, even if it costs more time, effort, or flexibility. Others notice small frictions, delayed responses, or changing language, and adjust behavior without announcing concern. These individual choices are rational on their own, yet together they alter the balance the system depends on. Markets are not fragile because they are dishonest, but because they rely on coordination that no one explicitly controls. Coordination works until too many actors independently reach the same conclusion at roughly the same time. This is why stress feels sudden, even when it has been building quietly for years. By the time prices react, the real shift has already happened beneath the surface. The meaning of ownership changes first, then the meaning of delivery, and only later the meaning of price. Charts cannot capture this process because charts only reflect transactions, not expectations. Silver exposes this weakness clearly because it cannot be substituted endlessly without consequence. You can delay delivery, redefine settlement, or encourage alternatives, but you cannot create metal through agreement. The system manages this reality through time, flexibility, and trust, stretching assumptions rather than confronting limits directly. That approach works remarkably well, which is why breakdowns are rare and widely misunderstood. When they do occur, they are often explained as anomalies rather than lessons. Yet history shows that every major market disruption followed a long period where behavior changed quietly first. Silver's hidden breakpoint is not a warning of disaster, but a case study in how modern systems manage discomfort. It shows how markets prefer adaptation over admission, continuity over clarity. This preference keeps things running, but it also obscures where pressure is actually building. Understanding this does not require predicting outcomes or assigning blame. It simply requires watching what people do when convenience and certainty stop pointing in the same direction. Silver teaches that the most important market signals are behavioral, not numerical. By the time those signals reach the chart, the story has already moved on. The breakpoint is not a moment of failure, but a moment of recognition, and recognition, once it spreads, quietly reshapes everything that follows. Silver keeps revealing pressure inside financial systems because it cannot stay abstract forever, forcing promises to eventually confront physical reality. Unlike purely financial assets, silver moves through factories, infrastructure, and supply chains where delays have consequences beyond accounting entries. This makes silver uncomfortable for systems optimized around speed and efficiency rather than redundancy and physical certainty. Financial markets prefer instruments that can be rolled forward, offset, or delayed, without forcing hard logistical decisions. Silver resists this preference because at some point it must exist in usable form, in the right place, at the right time. That requirement turns assumptions into operational problems, and operations cannot be smoothed as easily as narratives. When supply tightens, the first reactions are rarely public, as industrial buyers quietly adjust sourcing behavior behind the scenes. These changes do not show up immediately in prices, but they alter how contracts are used and how risk is quietly perceived. Institutions managing silver flows are experienced at maintaining order, often resolving tension before it becomes visible to outsiders. However, visible calm often reflects active management rather than balance, and that distinction matters when pressure persists. History shows silver repeatedly appearing when abstraction expands faster than physical buffers can realistically support. It does not cause failure, but it reveals where flexibility has replaced certainty without sufficient margin. Each cycle looks different on the surface, shaped by regulation, technology, and global demand patterns. Yet beneath those differences, the same structure reappears, with paper claims growing faster than physical redundancy. This structure works well until redundancy is needed, and then its absence becomes quietly obvious. Markets respond by adjusting timelines, language, and procedures, reframing stress as routine operational complexity. These responses are usually accurate, but they also postpone recognition of where the real limits exist. Silver forces recognition eventually because consumption cannot be delayed indefinitely without real consequences. Factories cannot operate on reassurances, and infrastructure cannot function on flexible settlement terms. As a result, silver exposes the hidden cost of systems built for smoothness instead of resilience. This exposure happens slowly, first visible in behavior rather than headlines or dramatic market moves. Participants closest to supply adjust priorities long before observers notice anything unusual. By the time attention focuses on silver, adaptation has already been underway for years. Silver's role is not to break systems, but to reveal what those systems chose to ignore. It shows how markets manage discomfort by spreading it across time rather than resolving it. That strategy works impressively well until time itself becomes the constraint that can no longer be extended. Silver almost never sends obvious warnings because modern markets are trained to react only to price moves, not to slow changes in behavior and process. Participants learn to trust charts and volatility as the language of risk, so signals that do not move price are treated as unimportant background noise. Structural stress behaves differently, appearing first in procedures, delays, substitutions, and subtle changes in how routine obligations are handled. These signals feel administrative rather than dramatic, which makes them easy to dismiss as normal complexity instead of meaningful structural change. Markets are designed to absorb friction quietly because visible friction threatens confidence more than imbalance itself ever does. As a result, early warning signs are reframed as technical details that professionals are expected to manage without public concern. This framing is effective, keeping participation orderly and preventing sudden coordinated reactions that could destabilize the system. But it also trains observers to ignore patterns that only become obvious once they have accumulated over long periods. Silver has followed this pattern repeatedly, sending signals that were understood only after conditions had already shifted. In past cycles, delivery terms changed, sourcing became less transparent, and rules evolved gradually before attention finally followed. At the time, each adjustment seemed logical, temporary, and justified by immediate circumstances facing the market. The issue is not flawed reasoning, but accumulation, because small rational changes compound into structural transformation. By the time the transformation becomes visible, the system already behaves differently than it once did. Most participants adapt instinctively, shortening timelines or seeking flexibility without needing a public explanation. This adaptation does not require fear or panic, only awareness that incentives and risks are slowly changing. Markets struggle to recognize this phase because nothing appears broken on the surface. Prices remain orderly, liquidity persists, and institutions continue operating in familiar ways. This creates the impression that concerns are exaggerated or speculative rather than rooted in structure. History shows that the most important transitions happen during these quiet, uneventful periods. Silver exposes this weakness because its physical role forces early adjustment by those closest to supply. Those near the metal feel pressure first, while distant observers see nothing unusual at all. This gap in perception explains why warnings are dismissed until they can no longer be ignored. By the time a signal becomes obvious to everyone, it has stopped being a warning. It becomes confirmation that behavior has already shifted beneath the surface. Silver's lesson is not about prediction, but about how systems communicate discomfort. They do not shout, they normalize, adapt, and move forward until assumptions quietly expire. Understanding this explains why market stress always feels sudden, even when it has been building for years. The silver market does not end with a dramatic failure or a clear resolution, because real system stories rarely finish with a single visible event. Instead, this story ends with perspective, when patterns that once felt abstract or disconnected begin to align into something understandable. Silver reveals how modern markets are designed to avoid confrontation, prioritizing continuity and confidence over direct engagement with limits. That design is not accidental or malicious, but the result of decades spent learning how panic spreads faster than facts. The cost of this approach is distance, where stress is redistributed quietly instead of being resolved openly and transparently. Over time, this distance creates a gap between how markets look on the surface and how they actually function underneath. Most observers never see that gap because price and liquidity continue to behave as expected for long periods. Silver exposes the gap because it cannot remain theoretical forever, no matter how sophisticated the system becomes. At some point, metal must move, production must continue, and logistics must meet promises made far from factories. When that alignment becomes harder, behavior adjusts quietly, long before explanations reach the public narrative. This is why market shifts always feel sudden, even though they develop slowly among those closest to structure. Nothing breaks all at once, but meaning changes, and meaning is the foundation every market rests upon. Ownership starts to feel less abstract, delivery feels less optional, and certainty becomes more valuable than flexibility. These shifts do not require fear or speculation, only recognition that assumptions no longer fit reality as comfortably. Silver's story is not about collapse, but about limits that were always present and carefully managed over time. It shows that stability often reflects constant effort rather than natural balance or inherent strength. Understanding this changes how calm markets are interpreted, not as proof of health, but as evidence of maintenance. The most important signals are never loud, because loud signals force reaction and threaten coordination. Instead, systems communicate through subtle friction, timing changes, and evolving behavior that most people overlook. Silver reminds us that markets are social systems first, physical systems second, and numerical systems last. Numbers follow behavior, and behavior follows incentives long before charts reflect any change. By the time stress appears on screens, the real story has already unfolded beneath them. This does not mean outcomes are fixed or predictable, only that they are shaped quietly over time. Silver's hidden breakpoint is not a forecast of what comes next. It is a lesson in how systems reveal what they can handle and what they can only delay. Once you understand that lesson, markets stop looking calm and start looking carefully managed.